Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're touching on a very important and popular topic, certainly coming out of Bourse's recent investor webinar, and that is how do investors position themselves or invest in these particularly choppy markets that are being experienced both in equities and across the bond markets. And certainly that has been at the forefront of investor minds. And today we're going to take a look at a few tips as to how investors can think about the current environment and navigate it safely or relatively safely. The first item or the first tip in terms of investing in choppy markets that we're going to touch on today is to not panic or don't panic and to think long term. And why would we say not to panic or don't panic? Well, business cycles, economies and financial markets naturally move through different cycles. And right now, we may be best describing the current environment as in a slowdown phase heading into maybe a slight or narrow or shallow rather recession before bottoming out and moving back into that recovery phase. So right now, we're perhaps in that slowdown measure with slowing economic growth, increasing inflation, and a generally more muted investor sentiment. So that is not a reason to panic and not a reason to just sell everything and go into cash. Business cycles, economies, and financial markets naturally move through those periods of ebbs and booms. When we take a look at the longer term aspect of this particular tip, we can see from the S&P 500 index's historical performance that over the long term, stock prices have increased fairly consistently despite those one or two periods of negative or down markets. Generally, those have been fairly short-lived, followed by fairly longer periods of positive market performance. And over the past 42 odd years, for example, the S&P 500 would have increased from an index level of just about 119 to its current level, closing level on Friday of just about 3,790. Which is on an annualized basis about an 8.7% increase per year. And that is excluding dividends. So certainly investors who are thinking long-term and in it for the long haul might be better rewarded as opposed to panicking and getting out of the market at the first sign of distress. The second topic or tip that we can offer is to buy value and sell hype and embrace opportunity in the current environment. And what would investors or should investors look for in identifying value positions for your portfolio versus hype? Well, on the value side of things, look for companies or businesses with wide economic moats, meaning they have very significant and defensible competitive advantages. They may be industry or sector leaders having a very large company value as indicated by their market capitalization, or a very popular, have very significant network effects, and also a proven financial track record, certainly delivering profitability throughout economic cycles. Microsoft is a name that would tick pretty much all of these boxes, and in the current environment would have fallen more than 30% from its all-time high, and is certainly looking much more attractive to investors. On the other side of things, try to avoid adding hype-type investments to your portfolio, and those would be companies or businesses with limited competitive advantages or non-defensible competitive advantages. It may be an investor fad or trend, or basically riding momentum from a current, what eventually short-lived trend or fashion, and they have limited or no financial history. A company that might come to mind that might fall into this hype category would be Zoom, where there are many credible competitors, Microsoft Teams, Google Meets, for example. It would have come to the forefront of investors' minds because of the coronavirus pandemic, which is still going on, but certainly starting to recede. And they would have had very limited to no financial history since becoming public fairly recently, a couple of years ago, and certainly have had their revenue and profitability challenges. The third option or tip that we can offer to investors in this environment for investing is diversify. And diversification helps whether or not we're in choppy markets or relatively calm markets. How can investors achieve diversification? Well, you can build it yourself by acquiring and selecting your own wide variety of individual stocks, high yield bonds, investment grade bonds, looking at instruments such as repurchase agreements and fixed deposits, etc. Or you can buy ready-made diversification through many investment options available locally or in the local investment landscape. And we're talking, of course, about items or investment options which have that natural diversification, such as equity mutual funds, balanced mutual funds, equity ETFs, those fixed income or bond funds and ETFs, as well as income mutual funds. And if all else fails and you're still not comfortable investing in this choppy market, well, when in doubt, opt for safety. That's the final tip we're going to offer today. And when you're looking at safety, you have to consider the fact that you may miss out on opportunities if the markets quickly turn around, and you will slow down, inevitably slow down how quickly you build your wealth or accumulate wealth over time. But it is, again, the safer option, and you can look at instruments such as income mutual funds, repurchase agreements, fixed deposit type instruments, as well as investment grade bonds, typically government bonds in TT dollars, Trinidad and Tobago government bonds, or in US dollars, US government treasuries, two of the safest asset classes in those respective currencies. So those are some of the tips for investing in choppy markets. And if you'd like to learn more about today's topic, or just generally get some helping hand on your investment journey, you can give us a call at 226-8773. Email us at invest@boursefinancial, or check out our website at bourseinvestment.com, where all of our research is absolutely free. And of course, you can catch this topic in today's business section of the Trinidad and Tobago Guardian newspaper. Until next week, stay safe. This has been the Bourse Report.